Ladies and gentlemen, good day and welcome to Infosys Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Mahindra. Thank you, and over to you, sir.
Thanks, Inba. Hello, everyone, and welcome to Infosys earnings call to discuss Q1 23 financial results. This is Sandeep from the IR team in Bangalore. Joining us today on this call is CEO and MD Mr. Salil Parekh, CFO Mr. Nilanjan Roy, and other members of the senior management team. We'll commence the call with some remarks on the performance of the company by Salil and Nilanjan, subsequent to which we'll open up the call for questions. Please note that anything which we say that refers to our outlook for the future is a forward-looking statement that must be read in conjunction with the rest of the company faces. A full statement and explanation of these risks is available in our filings with the SEC, which can be found on www.sec.gov. I'd now like to pass on the call to Salil.
Thanks, Sandeep. Good morning and good evening to everyone on the call. Thank you all for taking the time to join us. We've had an excellent start to the financial year with 5.5% sequential growth and 21.4% year-on-year growth in constant currency terms. We continue to gain market share with our Cobalt cloud capabilities and our differentiated digital value proposition, driving a significant pipeline of opportunities for us. For example, a premier online retailer in the US leveraged Infosys Cobalt to embark on a cloud-driven transformation journey to enhance their customer experience and improve their security posture. Another example is a European manufacturer who's reimagining their digital workplace and best-of-breed network security with IT infrastructure powered by Infosys Cobalt. There are examples like this all across the spectrum in different sectors that are driving Infosys Cobalt into the market. Clients continue to place an immense amount of trust and confidence in Infosys to help accelerate their digital transformation agenda, both on efficiency and the growth dimension of their business. The strong growth we have seen in the quarter lays a robust foundation for the year. Growth continues to remain broad-based across the segments, service lines, and geographies. Each of our business segments grew in double digits, with several of them growing at 25% or higher. In terms of geography, the US geography grew at 18.4%, and Europe grew at 33.2%. This indicates a healthy demand environment and is a reflection of how our industry-leading digital capabilities are relevant for our clients. Our digital revenues were 61% of the total and grew at 37.5% in the quarter in constant currency terms. Within digital, our cloud work continues to grow faster, with our Cobalt cloud capabilities seeing significant traction with our clients. Our overall pipeline remains strong. We do see pockets of weakness, for example, the area of mortgages in financial services. We keep a close watch on the evolving macro environment in terms of the changes to the pipeline. Within our pipeline, we also have focus, in addition to the growth areas in digital and cloud, to the cost areas through automation and AI. Our operating margins were at 20%. We have completed the majority of our compensation review for this year. Nilanjan will also provide more details on the overall margin update. Some other highlights of our results are we signed 19 deals with a large deal value of $1.69 billion. This comprises of 50% net new work. Our on-site mix was at 24.3%. As we build capacity for the future, our utilization was at healthy levels of 84.7%. Our free cash flow was strong at $656 million. Our quarterly attrition declined. And historically, Q1 attrition increases 3 to 4 points sequentially on a quarterly annualized basis. However, our attrition declined by 1 point on a sequential basis, reflecting the impact of various initiatives we have put in place. We had a net headcount increase of over 21,000 employees, attracting leading talent from the market. This is a reflection of our enhanced recruitment capabilities, solid brand, and deeper penetration into various talent markets. Our COBOL cloud capability continues to be market leading. We have 360 technology and domain solutions. 5 of our assets have over 50 clients each. We have 150 industry-focused solutions, 20 Infosys living labs, 50 experimentation playgrounds, and 60,000 knowledge assets. Our One Infosys approach is serving us well to bring the best of Infosys in service to our clients' needs. Earlier this month, we announced the acquisition of Base Life Sciences, a Denmark-based technology and consulting firm in the life science industry. Base brings to Infosys domain expertise in medical, digital marketing, clinical, and regulatory areas. With our strong growth in Q1 and our current outlook on demand opportunity and pipeline, we increase our revenue growth guidance, which was at 13 to 15%, now to 14 to 16% for the full year. We keep our margin guidance at 21% to 23%. With the increased cost environment, we will be at the lower end of this margin guidance. Thank you. And with that, let me hand it over to Nilanjan for his update.
Thanks, Salil. Good morning, everyone, and thank you for joining this call on an early Monday morning. We had a strong start to fiscal 23 with a robust year-on-year growth of 21.4% in constant currency. All our business segments and major geos recorded double-digit growth, with manufacturing, communications, and Shore, along with Europe region, recording 25% plus growth. Sequentially, revenue growth was 5.5%, which was led by a healthy volume growth and some RTP benefits. Digital revenues now constitute 61% of total and grew by 37.5% in constant currency. Client metrics were strong, with increase in client count across revenue buckets compared to the previous year. Number of $50 million clients increased by 10 to 69, creating the next potential centurion. Number of $100 million clients increased by 4 to 38, and the number of $200 million clients has grown by 6 in the last 1 year. This reflects our ability to deepen mining across our large clients. We had another quarter of strong employee additions of over 21,000 to cater to the growth opportunities ahead. The fresher addition was particularly strong, which resulted in drop in utilization to 84.7%. On-site effort mix inched up to 24.3%. Voluntary LTM attrition increased marginally to 28.4%. Quarterly annualized attrition declined by another 1% from Q4 levels, despite Q1 usually seeing an uptick due to seasonality. As announced earlier, we have given competitive salary increases for majority of employees from April. Given the supply tightness and high prevailing inflation, salary increases across all geos this year are higher than historical levels. The increases vary based on job levels and performance of employees, with top performers getting double-digit hikes. Salary hike for other employees is being done effective 1st July. Q1 margins stood at 20%, a drop of 150 basis points versus previous quarter. The major components of the sequential margin movement were as below. Headwinds of 1.6% due to salary increases, 0.4% due to drop in utilization as we create capacity for future, 0.3% due to increases in subcon, third party, and other costs. These were offset by tailwinds of 0.5% due to increase in RTP from higher working days, a reversal of a client's contractual provision in our FS segment, partially offset by discounts. 0.3% benefit from rupee depreciation benefits, partially offset by cross-currency headwinds. Q1 EPS grew by 4.4% in rupee terms on a year-on-year basis. Our balance sheet continues to be strong and debt-free. Consolidated cash and investments were 4.4 billion at the end of the quarter after returning more than 850 million to the shareholders through dividends. This has led to an increase in ROE to 31%. Free cash flow for the quarter was 656 million, which is a conversion of 95% of net profit. Yield on cash balance remained stable at 5.3% in Q1. DSO declined by 4 days sequentially to 63. DSO including net unbilled was 82 days, an increase of 1 day versus Q4. Coming to segmental performance. We signed 19 large deals in Q1 with a TCV of 1.69 billion. This comprises of 50% net new. We had 5 large deals in retail and CPG, 4 in high tech, 3 each in financial services and energy, utilities, resources and services, and 2 each in manufacturing and communications verticals. Region-wise, 15 were in Americas and 2 each in Europe and ROW. In financial services, clients are continuing to focus on digital customer experience, contact center transformation, and virtual branches aimed at improving customer engagement. While the order pipeline remains strong across regions, we have seen some slowness in mortgage industry and lending business due to increased interest rates. We remain watchful of impact of emerging global developments on budgets of clients. In the retail segment, the pace of digital transformation, large-scale cost takeouts, and improving business resilience continues to be on the rise across various subsegments. Our focus on proactive engagement has helped us in creating a robust pipeline. Clients are monitoring the emerging macro situation and the impact of that on their business. In communication segments, clients are focused on rapid digitization and protecting their assets from cyber threats. We see enormous potential to partner with them both on the digital transformation agenda as well as on the cost takeout front. Deep pipeline in energies, utilities, resources and services segments comprise of opportunities around cost takeout, vendor consolidation, digital transformation, cloud-led transformation, and asset monetization across industry sub-verticals. The manufacturing segment is seeing broad-based growth across geographies and industry sub-verticals. The sector is seeing traction across energy, IoT, supply chain, cloud ERP, and accelerated cloud adoption. In Q1, we have been ranked as leader in 9 ratings in the areas of Oracle Cloud, SAP S/4HANA, Public Cloud, Industry 4.0, Employee Experience, and Automation Services. In this supply-constrained environment, we continue to invest in our growth momentum, which requires us to hire premium skilled talent while simultaneously investing in existing employees through competitive compensation increases across geos. Additionally, we expect normalization of costs like travel and other overheads. We will continue to focus on various cost optimization measures, including rationalization of subcons, flattening of the pyramid, increasing automation, reducing on-site mix, and increasing pricing. Whilst we retain our operating margin guidance of 21 to 23%, we expect to be at the bottom end of the range. Revenue guidance for the year has been revised to 14 to 15% from 13 to 15% earlier. With that, we can open the call for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Surendra Goyal from Citigroup. Please go ahead.
Yeah, hi. Thanks for that. Good morning. Just a couple of questions from my side. Firstly, a clarification. So, Nilanjan, I believe you said that the contractual provision was largely offset by discounts. Could you please clarify a bit? Did you mean discounts to the same client or discounts in general? Curious because on one hand, we are talking of a strong demand environment and potential price hikes, and at the same time, we are also talking of discounts.
So, the comment was that it's not the entire 0.5% increase in RPT is a combination of 3 to 4 elements. The higher working days, the client contractual provision reversal benefit, partially offset by discounts. So it's not a direct linkage of discounts and client contractual provisions. It's not to the same client. This is generic discounts. And these automatically keep on coming. But we have, like I said, we have come down less as we've started negotiating with our clients in terms of pricing. But that's the net impact of all these.
Okay, sure. And just another question on margins down 360 bits year over year. Operating profit is growth YOY is worse than historical trends despite all the strong demand and growth we are talking about. So if you just think about this 360 basis point decline, how much of that is really investment which you think can be recouped as we go forward from here?
Yeah. So like we said, when we were 360, we knew we were having some benefits in a way of the back end of COVID. Our utilization was very high. We were really at 88%, which we've never operated before. The benefits of travel, etc. Now we are seeing that more and more that has been coming back. So that's something which we were well aware of in last year. But as we see the demand volume ahead, I think we are very clear that in terms of our ability to support this demand, we firstly have to hire. We have to pay competitively. So we actually did 2 wage hikes in calendar year 2021, and now this year we've already rolled out in March year. So within 1.5 years, we've done 3 substantial CRs, and actually in September last year also we did a fill base. So we've been continuously investing behind that, and we know that to capture this demand, we have to pay for premium skills. We have to go behind volume, in some cases subcon cost for us, from an industry, I think leading 6.5 position, we are closer to 11%. But again, these are something we know over a period of time. We have a lot of optimization levers, right? And we don't want to leave a 5-year demand on the table because of short-term cost pressures. And these we can optimize, over this year and over the future as well. So in that sense, we are quite confident, and that's why we have talked about we will be in the 21 to 23 at the bottom end of the range. And of course, if we are 20% today, we will see that improvement as the year progresses.
Sure. Thanks for that. I'll get back in the queue.
Thank you. Our next question is from the line of Moshe Katri from Wedbush Securities. Please go ahead.
Hey, thanks. Spectacular numbers, especially in the revenues side of the business. Just a follow-up to the last kind of topic or question about margins. We're getting a lot of pushback on that. From your perspective, looking at the levers that you kind of highlighted, what do you think is the biggest potential lever here for you to be able to kind of catch up to the margin range that you mentioned? And then I have a follow-up after that.
Yeah. So, Moshe, hi. So I think firstly, if you see, our margin profile, how it has changed, right? So one, of course, has been this utilization and, in fact, high 21,000 net adds during the quarter, which is well above our volume. And that is to create the buffer so that when we put in freshers, we are able to train them, and then over a period of time, able to put them into production, right? So you can't just hire freshers and expect them to start, contributing from day one. And we are very vigilant about that. They go through our mandatory training in Mysore, and then we put that. So that's one big part of, where we think we can start improving. As the hiring has caught up, automatically you see the stabilization of subcon costs, right? As a percentage of revenue, you were seeing this increase every quarter. Now you've seen a sort of flattening out. And over the future, as we've got our recruitment tax together and been able to hire freshers, we should see benefits coming out of that. Pyramid benefits will continue to happen for us. While we have seen some adverse impact of the on-site movement, this is largely as travel overseas has picked up, but we think this is more of a aberration in terms of uptick, because the inherent story of we're taking costs out and having a more offshore mix in the entire cost optimization that should come into benefit, especially in this environment where cost takeout is becoming a big theme across our clients. So we know we can have multiple areas. Pricing is another thing we've been talking about. We have seen less impact of pricing in terms of discounts, etc. We are going back to clients in terms of COLAs, in terms of when our renewals happen. Now, again, these are much more, longer-term, impact decisions. But I think at least the conversations have started in right earnest across, all the segments. And you can hear similar commentary across. So I think these are the areas we continue to, focus on. And that's something we've done, over the years. We've seen that we continue to be very, forceful in terms of our cost, efficiency exercises.
Okay. And just as a follow-up, just remind us, what's the sensitivity for margins versus utilization rates, i.e. 100 basis points expansion in utilization rates? What does it mean to margins in terms of sensitivity? Thank you.
Yeah. So I think it depends on by which levels we see utilization. So it's quite complicated. It's, you have a different utilization in on-site, different in offshore, and then the impact of pressures in the pyramid in that utilization. So it's a bit complicated how the mix changes. So I just can't give you off the number of, what 1% will lead to. But to give you a large impact, we lost in this quarter, I think 40 basis points because of utilization and margins.
All right. Thanks for the color.
Thank you. Our next question is from the line of Kumar Rakesh from BNP Paribas. Please go ahead.
Hi, good morning. Thank you for taking my question. My first question was continuation on the margin side. So at the end of the fourth quarter, and not just Infosys, but across the industry, what the management commentary had indicated, compared to that, the margin performance appears to be a sharper decline. Now, Salil, what do you think could be the reason behind that? Is it driven by higher than expected demand and hence higher use of subcontracting than what you were planning earlier? Or is it more supply side driven that the pressure was higher than what we had planned for through the quarter?
Yeah, you're talking about us in particular or the industry?
Anything, whatever you could give us color on, because the trend has been very similar across your hand.
I think so we don't operate in a vacuum, and this industry doesn't operate in a vacuum. The attrition trends are pretty much very similar across industries. But the good news, like you said, is that attrition is coming down. Our quarter attrition figure is actually below our LTM figures. And as Salil said, we're already 1% down. On a sequential basis, we were 5% down in the previous quarter, and we were flat. So I think this is more the reported LTM, of course, is more of a catch-up effect. And in that sense, you will see start stabilization. The pressures will start coming in and getting permeated. So that benefit, in a way, should start creeping into the cost structure, right? Because at the end of the day, if you're putting pressure, you have less attrition. The stretch hike which you have to give for lateral hires should come down. The joining bonuses impact should come down. So these are the things which will play, in our favor. And like I said, you've seen these numbers of declines pretty much across industries. But we have, I think, a very, very sharp cost optimization program in a way which will go and offset these headwinds.
Got it. So it appears the supply side pressure was higher than what we were expecting. My second question was on the.
I think there's no question about that. In terms of if you see our attrition and our net adds, the gross hiring has been very high, and of course, that tells in terms of our stretches and all we have to offer. So it is an overall industry issue led from the demand side.
Sure, thanks. My second question was on base acquisition. So we already have a pretty strong life sciences practice with more than $1 billion scale. So what exactly we are looking and targeting to get help from this acquisition?
On base, there are multiple things. This is a business which is very high-end in the life sciences area. When we launched our strategy a few weeks ago, just at the start of the quarter, we had shared also a new focus or expanded focus on Europe. And Denmark, for us, is a very strategic market. The whole Scandinavian market is a very strategic market for us. So that's the second area that it benefits us in. And we also see clients are using the capabilities of base as a starting point, and then that leads to large technology transformation, digital transformation. And that helps us overall in terms of scaling up that segment. That's a segment which we feel is a strong segment for the future, and where we are, in our view, underweight in percentage terms. So we want to enhance that with our deep existing capabilities.
Got it. Thanks a lot for that, Salil.
Thank you. Our next question is from the line of Keith Bachman from BMO. Please go ahead.
Hi. Thank you very much. My first question is I wanted to get your views on how you think wage inflation will impact the balance of the year, and what are the tensions on that to your margin model. So you mentioned that attrition has in fact moved lower, do you think attrition continues to move lower, and how do you think wage inflation will unfold over the next, call it 3-4 quarters, and be a force in the gross margin equation? And then I have a follow-up.
Yeah. So I think, we started last year, we were very clear that we have to be competitive in the market. So we did the first hike in January of 21, then we did the next hike in July of 21, then we did follow-up on the free talent in September of 21, and in a way we have not waited 1 year. We've actually gone ahead and done our majority of our wage hikes from 1st of April this year. There's a little carried on effect in terms of the more middle to senior, higher middle to senior folks, which will happen in July, but not in the same margin impact of quarter one, which was very broad-based. But other than that, I think we think these are quite competitive, and of course, if you see in the mix, we also get a lot of laterals, and there's a hidden cost of hiring laterals because they come expected. So in a way, your compensation overall, weighted average compensation, in any case, is going up across. But I think overall, I think this is a very competitive hike in terms of in India, it's more like high single digits. And in overseas geos also, because of high wage inflation across, we have given very competitive hikes, something which we've not done in this kind of wage environment and inflation environment before. So these are very much higher than what we've given in the past. But we think this is something which is going to stand us in good stead in terms of attrition. And like I said, we've seen sort of 3 quarters of the attrition benefit, over a period of time flowing in.
Okay. We cover a number of software companies, and software companies have started to say they're seeing pockets of weakness with demand elongation on sales cycles. It doesn't sound like, I know you made one very specific industry comment, but it doesn't sound like you're seeing the same, any kind of iteration on the demand side, particularly on the negative side. But if you could just clarify, are you seeing any elongation on the new business front? And yes or no? And if the macro does weaken, will that in fact help your wage situation? And that's it for me. Thank you.
So thanks for that. This is Salil. Couple of points that you raised. I think what we see on the demand, the pipeline that we have today for our large deals is larger than what we had 3 or 6 months ago. Having said that, we of course recognize what is going on in the global environment, and we mentioned a couple of areas. Nilanjan talked within retail. He also mentioned, I shared within financial services, mortgages. So we see pockets where we see some impact. On the overall deal discussions, we see a little bit where it's slowing in the decision making. However, the pipeline remains strong for us today. We've also got 2 types of deals. One is deals which are on digital transformation or cloud, which are growth orientated for clients, driving to what they want to do with their customers or in their supply chain, how they want to make an impact there. And the second is on cost. We have a very strong play on cost and efficiency through our automation work, through our artificial intelligence work, where we can really impact the cost base in the tech landscape of our clients. So those are areas which we are already very active with within this environment. And given our positioning, we feel good that those will start to come into play as and when the environment changes. But today, this is how we're seeing the demand situation. Now, your other question was, will that have a change on the wage or if the macro evolves? We don't have a clear view on where that will go because it's a function of how the macro evolves and what happens. Of course, we are seeing attrition starting to come off a little bit. That will clearly have a positive impact for us with respect to compensation. So the timeline is not clear. It depends on how the macro evolves.
Okay, great. Many thanks.
Thank you. Our next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Hi, good morning. Thanks for the opportunity. I have two questions. So one is from a margin perspective, whatever we saw as one-offs in the previous quarter, which included visa and this contract provisions, both of them have been sort of offset in this quarter. Is that a fair understanding? That's the first. The second is, in terms of salary increases, is it only for the associate level this quarter? And if so, then the question is that we have 145,000 associates, JL3 and below, and some 130,000 people in the mid-level. And general understanding is mid-level, obviously, as a percentage of the employee comp cost, it should be higher. So the thought process was, shouldn't your margin even be higher next quarter? If you could just help with that thought process, that will be very helpful. Those are two questions. Thank you.
As I said in the margin walk, we had a benefit of 50 bits from in RPP, which is a combination of working days, client contractual provision reversals, partially offset by discounts. So we've seen a benefit there. So now there's no, in a way, what you said that has been eroded. We have got the benefit of client contractual provisions clearly. The other one on visa travel, I think they were largely, offset against each other. And what was the other question? On the outlook on wages, yeah, so like I said, we've done it for most of our employees, right? It is up to mid-level, and more at the senior levels is what we're going to roll out in July, and that impact will be far less than 1.6%, which we've done, which is much more broad-based across.
Sure. So both associates and mid-level happen this quarter itself. It's not only associates.
Yeah. No. Yeah.
Sure.
Associate and mid-level, correct.
Perfect. That's very helpful. Thank you so much.
Thank you. Our next question is from the line of Bryan Bergin from Cowen. Please go ahead.
Hi, thanks for taking the question. I wanted to just dig in on the commentary around pockets of weakness. So heard you mention mortgages, mentioned, I guess, the stuff component of retail. Can you just give us a sense, maybe quantify what mix of your business is actually seeing some slowing decision making? Is it 5%? Is it 10%? Is it less? Anything to just help frame or quantify areas that are seeing pockets of weakness?
So thanks for your question. This is Salil. We don't quantify typically, what part of our financial services, mortgages, or the other areas which are impacted. We're now seeing pockets. This is not across our whole business. And the way I would sort of look at it is, with all of that, given our pipeline, we've increased our revenue guidance. So the majority of our business is still seeing good demand. It's really pockets without quantifying. That's how I would give a context to it.
Okay. And then just a follow-up on margin. You gave sequential changes. Can you give us what the year-on-year changes in operating margin, the different categories?
Yeah, so largely we know it was the comp-related hike that's nearly about 350 basis points. That was one of the biggest ones. And this was offset by some rupee benefits, which was also as a benefit, but there was cross currency as well, which offset probably half of that. And then we got some benefits of cost optimization. We got some hits on lower utilization. So these were the broad things, but the biggest one was comp, which was about 370 basis.
All right, thank you.
Thank you. Our next question is from the line of Sudheer Guntupalli from Kotak Mahindra Asset Management. Please go ahead.
Yeah. Good morning, gentlemen. Thanks for giving me this opportunity. I have just one question on margins. Ideally, the strong growth at the headline level should have translated into some operating leverage, but that doesn't seem to be happening. And Nilanjan, we seem to be of the view we'll chase growth for now and focus on margin optimization at a later date. What is the risk to that hypothesis? Because this growth margin paradox seems to be a mere reflection of what is happening in US and UK now. A very tight job market, very high nominal growth, but very little benefit trickling down to the bottom line level. So sooner or later, this nominal growth rates may cool off, and on-site job markets and some supply costs may auto-recalibrate. But back in India, job market may not be as much of a free market as it is in UK and US. There may be some sticky elements both at headcount and wage level translating into negative operating leverage as demand moderates. So what is the risk that margins will remain structurally lower than even the pre-COVID levels going ahead? Because demand tends to be more cyclical while some of these supply costs tend to be more sticky.
Yeah, so a couple of things. See, one is that many of these cost increases can't be passed on to client on day one, right? So if I have to give a wage hike on all my existing base, right, they will come up for renewal, right? That's the time when you have a wage discussion. When you're doing new deals, automatically we will build it, and the industry in a way builds it into their wage profile. So these things will automatically flow back. There's no free lunch for anybody, right? So that's one thing which will happen over a period of time. But that's more of a, a generic point I'm making. But in terms of, say, subcon, right, we've operated at 6.5% of subcon. Today we're sitting at, 11.1%, right? There's no reason for us to be at these levels because we know what wage market, the overall demand environment, our recruiting picks up. We can replace these subcons with our own headcount, put more pressure into projects, and this is something we've been doing very well in the past as well. So I think these levers are well known for us. We know how utilization works. We know how pyramid works. So we're quite confident in the go-forward model of taking out costs from our overall structure.
Just one more question, if I may. So when we say the pipeline is larger now, just curious if the pipeline is getting bigger and bigger because some of the decision making is getting slower. Is there any correlation you read it between the two?
So there, Salil, the pipeline, what we are seeing is there is appetite, and you go by different industry, for digital transformation programs, for large cloud programs, for programs which start to relate to cost and efficiency. That's what is in the pipeline. It's not a function of the timeline, which the delay that you referenced, which is causing an increase. It is where we see traction with more and more client discussions as of today that we see. Now we will see how that evolves, but that's the outlook we have today.
Thanks, Salil. Thanks, Nilanjan. That's it from my side. All the very best.
Thank you. Our next question is from the line of Ankur Rudra from JP Morgan. Please go ahead.
Thank you for taking my question. First question is, what's the level of conservatism or realism infused into both the revenue and the margin guide this time? Part of that is on the revenue guide, given the potential macro headwinds ahead of us and the ask rate from the second half of this year. And similarly, on margins, we still have another round of wage hikes, which could impact margins by maybe as much as 100 basis points if I look at the wage hike impact so far, and a similar ratio between the first and the second rounds in the previous years, and also keeping up travel and facility costs. Thank you.
Hi, Ankur. Thanks for the question. This is Salil. Let me start off, and then Nilanjan may have a few points to add. On the guidance for growth, as we've shared in the past, the approach we take is we see how things are as we look at the financial year today. So what we saw is in Q1, we had extremely strong revenue growth, 5.5%. We also had underlying volume growth that Nilanjan referenced, which was very strong. Then we see the outlook where we have clarity looking ahead for some period of time, and then a set of estimates that we have for the rest of the financial year, and also looking at how typically H2 works versus H1, and then putting in some views on where the end of the year could be. Based on that, we felt comfortable to increase the revenue growth guidance. Whether it's conservative or realistic, that is the approach we take to make sure that we then share what we think the revenue is going to look like for the year. On the margin, I'll start off and then Nilanjan will talk a little bit about the wage component and what we've done. Overall, on the margin, we've made sure that we work to get all of the levers in place. So the approach to driving cost efficiency is in place. Several levers that Nilanjan mentioned. One of the bigger ones, we've got the vast majority of our compensation increase already done in Q1. So yes, there's a small component, but it's not nearly a huge component that will come up. And then we see steadily other areas which will help us. There are areas where we can focus on how the subcontracting works. There are areas where we can focus on discussions with clients vis-a-vis wage increases and COLA. There are areas where we're doing work which is driving significant impact for clients. So we think there are a set of those levers that can help us through the margin discussion that will be focused on this financial year. Our approach very much is to make sure that we remain a high margin business, and that's the underlying theme that we're working with. Given where we are, given the inflation around the world, we thought it was clear to make sure that we communicated that in the way we see the market. Anything else you want to add?
No, that's good.
Okay, just a quick follow-up, if I may, on margins. Nilanjan, are there any one-offs in the margin this time? Asked another way, what would be the pro forma margins if the provision reversal was not to happen? And related to that, can you say that 20% in Q1 should be the bottom of margins going forward so that you can get back to 21% for the year realistically?
Yeah, so I think we mentioned the margin walk at the beginning of the call. So if we are 20 and we are guiding at the bottom end of 21, so mathematics dictates that we have to improve way forward. So absolutely, from 20 we will have to see the improvement quarter on quarter.
Okay, thank you and best of luck.
Thank you. Our next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Thank you. Gentlemen, congratulations on a good set of numbers. Just wanted your thoughts on how broad-based in North America you've not seen, I think, such broad-based growth sustained for a long time. And though you call out some headwinds in BFSI, isn't that still added quite a bit of revenue? If you could give some color about how sustained the demand environment is there. And secondly, on the pyramid, we've already seen a large intake of fresh graduates last year, so had hoped that some of that would have come into production and helped us offset the margin headwinds to this quarter. But looks like, given the utilization as well, it doesn't look like much of that has happened. So if you could give some color on that.
Hi, Ravi, this is Salim. I didn't catch the first part of the question. I think it was about demand, but maybe you can just say the first part.
It was around the demand, how broad, we've seen broad-based revenue addition across verticals in North America. And if you're seeing the pipeline also along similar lines, or are there any specific verticals where you see some softness starting to come in?
Yeah, so the softness, we are, as we referenced, we see some pockets of softness within our overall business. So we want to be very clear that is something that is visible. The couple of examples we've shared were financial services and retail, but there are areas where we see that weakness. However, once we say that, we also have a view and we see it in our pipeline. The overall pipeline is stronger. So there are areas where we see some good traction as well. And it's a mix of the growth and the cost opportunities within our pipeline. And I think the second one was about the pyramid, I think.
Yeah. So, yes, we've hired a lot of freshers last year, and many of them also have gone into, training pipeline, because as we had the previous year, there was nothing really in the pipeline in terms of hiring. So in fact, if you see our utilization, there's a 2% gap between the excluding trainees and including trainee numbers on a year-on-year basis as well. We continue to deploy them into projects, and like I said, we can't overnight in all projects put pressures in, and that's why it's important to build the pipeline in advance, make them go through the training, so then put them into production bench, and then move them into projects as well. So that benefit will come in, and we are seeing that slowly coming in. But it's important to invest ahead, right? If you just have just in time, you'd be probably sub-optimizing in terms of how fast you can deploy. So that's why we have made these investments, because we know it will take time for these sessions to go in, but it's important to make the investment ahead.
Thanks, gentlemen. One follow-up on this last quarter's contractual revenue. So did you recognize all of that this quarter, or is there still something pending?
Yeah, it was all recognized this quarter.
Thank you. Good luck.
Thank you. Our next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity. Salil, can you give some color on the overall order book since the reported TCV what we give? That covers only 50 million plus deal and may not really be representative. So any quantitative or qualitative comment on the scale and how the overall order book has grown, that will be helpful.
Thanks for the question, Pankaj. As you know, we share the large deals win number. We don't publish the overall deal wins. Having said that, the main sort of context I would put is the increase in the growth guidance that we've provided. That factors in that sense, all of the inputs that you may be looking for. Which then comes from essentially a very strong Q1 execution, the 5.5%, 21% growth, and then a view that we have on what we see in the coming quarters, and then an overall view of how we look at H1, H2 in our mix within the company. That is sort of broadly how we looked at it. On the large deals, we've shared this in the past. Typically, this is a number which is a little bit more volatile because we only report deals which are larger than 50 million in our large deals. And so that's really the way maybe to look at it.
Fair enough. My second question is on the profitability in the manufacturing vertical, where the margins has been coming down. And in fact, last 3 quarters, probably they have halved, despite a very strong revenue growth. I understand this could be because of a very large deal, which is still ramping up there. Can you give a sense how the profitability curve in this vertical could shape over the next 2-3 quarters? What I'm trying to understand is that, has it bottomed out now, or you think that this could potentially go down further? Thank you.
Yeah, so I think without specifically commenting, I think, on any particular deal, I think firstly, we've seen the revenue growth, which has been quite spectacular in this segment. This has been led by large deals. And as we've talked about our large deal approach, from day one, a lot of clients would like to see savings, but we are very clear that over a period of time, that we have a lot of cost optimization, because on day one, you can not pivot the cost structure, right? Whereas clients may ask for the savings. But we know over a period of time, the levers which we continue to deploy on all these large deals. And if I go back to the last 3 years, when 4 years, in fact, when the large deal sort of strategy started, we've actually seen an increase in margins over that. So there's been there's no historical correlation in terms of saying whether large deals are diluted, because we continue working on taking out costs to the system. And these are factored into our entire, bid process. We look at, how we're going to optimize on-site offshore. Many of these projects require dramatic automation. We can inject that through all our services, which we're providing. We know how the pyramid works. So these are things which we know, over the lifetime of these large deals. And that's something we know we can deploy. So that's something without getting into specifically manufacturing what we do well.
Got it. Thank you, and wish you all the best.
Thank you. Our next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi, good morning. Thank you for taking my question. So firstly, is there any difference in the client decision-making behavior in U.S. versus European clients? And the reason is that I'm asking is U.S. is seeing fair bit of broad-based growth across segments, but when we look at Europe, there is a weakness specifically in retail and communication vertical, whereas the other two verticals, energy side, high tech, has grown very, very well. So just trying to understand, are there any client-specific pockets, especially in Europe, where you kind of see decision-making behavior has changed compared to the U.S. market?
Thanks for that question. So today, we are not seeing that, which is more geography-based, as you're describing. We see some which is more globally industry-based, and our client base, as you know well, is mainly U.S., Europe, and Australia. So not so much color, which is more geography-related.
Okay. Second question on margins. Your margin outlook at the lower end, you explained very well the supply side and cost-related factors, which has led to this. But is there also an element of expectation of pricing increase that has been tapered down, which has led to you to now take the margin outlook to the lower end? And is it fair to say that with all the cost levers that you have in place, the exit margin should be better than the lower end of the guidance? Thank you.
Yeah. So I think when we do our sort of margin, forecast, there's a combination of factors we look at, and that equation keeps on changing. I mean, it's so dynamic. What happened in the previous quarter? What do we see as outlooks? What's happening on subcon, wage inflation? So that mix continues to change and evolve. Sometimes we have to push harder on some pedals in terms of accelerating some programs. And going back to the whole, if we are today at 20 and we are saying we're going to be at the bottom end of 21, I think that should give you a good sense of the margin trajectory for the rest of the year.
Thank you.
Thank you. Our next question is from the line of Ritesh Rathod from Nippon India. Please go ahead.
Yeah. Hi, everyone. Just on this margin, within a quarter, you have to lower your guidance on the margin side. So this is despite rupee depreciation benefit, despite attrition coming down in last 2 quarters. So what has surprised internally in your expectations so that you have to bring it down to the lower end?
Yeah. So I think, like I just mentioned, this is a very dynamic and moving, I could forecast completely what is the impact of attrition, how much wage hikes will come in for new hires. So it's very dynamic how does pricing play out. So in that sense, this is a very fluid situation, but the 21 to 23, we said we are within that, but of course at the bottom end of it. And we remain committed, from where we are today at 20, to do all our various cost optimizations, factoring in the cost impacts of what we see in terms of wage inflation. There could be potential benefits of the rupee, etc. So it's a combination of all this into the forecast.
And what would have been the biggest surprise element? Would it be the wage or would it be the pricing benefit not coming through? Any one highlight compared to what you expected at the start of the year?
It's a combination of various things. And I won't say surprise. I think, like I said, it's a fluid situation and we have to remain agile. That's more important rather than anything else.
And coming to pockets of weakness, which is pointed out, retail, mortgages, can you give some color? Are clients taking a pause in decision making? Are the new deals not getting converted, or are the existing deals which have been won, they are not getting ramped up? What's the exact sense on the weakness over there?
So there, within the areas of that pockets that we described, there we see a slowing. For example, if you look at the mortgage situation, the volume there in the market, meaning the client volume, at a macro level has gone down in the European, US market. so our work there is proportionally reduced. But the overall point which I shared earlier, we see some slowing in decision making, but nonetheless the pipeline remains today in a good position, and that allows us to increase the guidance.
Okay. And maybe last one on your deal wins, on LTM basis, your deal wins are down sharply, if you see last trading four quarters versus the previous 4 quarters. And even if I adjust the base because of the high value deals which you won in a couple of quarters, 4 quarters back, you're still down minimum by 15%. How do you connect those two dots that your LTM basic deal wins are down, but your deal pipeline is all-time high? Are the deal conversion ratios dropping than what it was historical?
There, on the large deals, we typically we always share, we see some volatility because these are deals which are larger, the ones we share in this number, which are larger than 50 million in value. We do see the pipeline being larger than where it was, and what we reference in some areas, a slowing of it, but we don't see any change in the other parameters on the pipeline.
Okay. Thank you. Wish you good.
Thank you. Our next question is from the line of Manik Taneja from JM Financial. Please go ahead.
Hi, thank you for the opportunity, and sorry for harping on the margin question once again. I just wanted to understand how should we be thinking about the segmental or the improvement in segmental margins for manufacturing vertical, given the sharp drop that we've seen over the last 3 quarters, and how does that read in terms of the overall margin outlook? Thank you.
Yeah, I know, like I guess somebody else has asked a similar question, and like without going into any specifics, we have seen that growth coming out of large deals in manufacturing, and like you said, as we look at the tenure of these large deals, in some cases they start off with lower than portfolio margins because clients may ask for savings upfront, but we have a very started plan in terms of over quarter on quarters. What do we need to do to bring back profitability? Because from day one, clients come to us because they know we can optimize the cost structure. So that's something which is generally what we've been doing since we started the large deal strategy, right? And we've seen margin improvement over that period. So I think we're quite confident of the future profile of these businesses.
Sure. Thank you.
Thank you. Our next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Yes, thanks for taking my question. Salil, this is on mega deals. While the industry frequency tends to be low and it's been a while for Infosys, it'll be good to know your comments on mega deals from a pipeline perspective. And secondly, on pricing, how is the ability to get price increase versus last quarter? Do you see any changes to that?
So on the mega deals, I think, again, we don't share anything specific in terms of what we publish. The color from our side is we have mega deals in our pipeline, if that sort of gives you a context. On the pricing, we've seen pricing currently holding in our deal values for Q1. My sense is we have seen examples that Nilanjan was sharing earlier, where we have worked with clients to demonstrate to them the impact of compensation increases, and that is translated to COLA or price benefits. We've had examples where we've had increases which are related from more of the digital high value work that we're driving for clients. We now have to make sure we take that across our whole portfolio and see the benefits coming into our business. Typically, the salary increase happens, at a periodic time, and these things where we've not seen a high inflation environment like this for over 40 years in the Western markets. That takes a longer time, but that's what, as Ranjan shared, is part of what we've put in place to support our margin as we go ahead there.
Thank you for that.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So thank you, everyone. This is Salil. Thanks again for joining for this call. I just want to summarize with a few points. First, we've had industry-leading growth in Q1, 5.5% quarterly, 21% year-on-year. We clearly see tremendous market share gain, driven primarily by the strength of our digital and the cloud Cobalt capability set that is resonating with our clients. We highlighted there are pockets of weakness, and we are aware of the environment around us. We see in our pipeline both growth opportunities in digital cloud and cost opportunities in automation. With all of that, we increased the growth guidance for the full year. We are now seeing attrition coming down on a quarterly basis. We see many of the initiatives we put in place starting to create some impact. We have levers for the margin, several that Nilanjan shared. Large programs will transition to a steady state. COLA, because of increases in compensation costs to pricing. Pyramid adjustments as we have college hires joining the production environment, subcontractor usage, and then several others on the cost side. Given all of that, we feel we are really well positioned to work with clients on their growth and cost opportunities and have a margin profile that is something that sustains the high margin approach of the company. So we're looking forward to this year with strength and optimism. And once again, thank you all for joining us, and catch up in the next quarter. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Infosys, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.